Good morning, good afternoon, good evening, wherever you may be. This is Sid from Elliott Wave Plus, and this is the June 13 of 2021 edition of my weekly counts webinar, where I go over all of my Elliott Wave counts and associated Fibonacci price targets for many of the world's major stock markets, commodities, currencies, and bonds. Hurst cycle analysis, as well as a number of other forms of technical analysis, will also be considered on virtually all items. Before we get started, I'd like for you to be aware of my disclaimer. It's at my website, elliottwaveplus.com. You go there, scroll all the way down to the bottom of any page there, and click on this Terms of Service Disclaimer tab. And there's the disclaimer. It's there all the time. So please go there and read that in full. If I were to summarize it in one sentence, it would be, there's risk of loss in all trading. Okay. Let's see here. Let's start out with the stock markets. I've prepared a few slides outside of Trade Navigator for you this week. And so we'll get started counting the waves, and I do have kind of some extra stuff I wanted to show you about the Hurst cycles this week. Well, I need to get rid of that. Hold on. There. All right. So, no change to the long-term count on Dow Jones Industrial Average. Still looking for the finish of 5 waves up from the 2009 low, the 1974 low, and the 1932 low, and that should, as soon as we get, and from the 2020 low. So as soon as we get the finish of a 5-wave up structure from the 2020 low into this collection of Fibonacci targets based on all of these degrees of trend, then I think we'll have a very significant major top in the stock markets. And I'll be labeling that as a grand super cycle degree top. And the target range, Fibonacci target range for that top is between 41,020 and 40. Excuse me. 43,652. So there's the target range that hasn't been hit yet. And so the challenge, once again, as it has been for weeks on end and months on end, is how are we going to count 5 waves up from the March of 2020 low into that target zone? And in my opinion, there's 2 ways to do it. One is that wave 1 in the Dow Jones Industrial Average is finished or very nearly finished now, and that we would get a relatively significant pullback for wave 2, and then we would get a 3, 4, 5, and what we would end up with would be an ending contracting diagonal. That continues to be my main count. And I have a frog in my throat. I'm going to suck on a Hall's mentholyptus here or something. Try to get rid of that. So I apologize if you hear something rattling around in my mouth. I sincerely apologize for that, but it's better than coughing. The other alternative is that we got a 1 and a 2 down here, and 3 is either still underway or is topping right now, and then we get a relatively small wave 4 and then a 5th wave up. The really interesting thing about that potential count, and that would be that we're putting in the end of wave 3 now, would be the if that's wave 1, and let's say wave 3 is done here, wave 3 would be shorter than wave 1 was. So if we were going to get a non-overlapping diagonal and we were putting in the wave 3 top now, it would be a short wave 3. We get a wave 4 likely down into the 18-month cycle trough due in late July, early August timeframe that I've been talking about for a long time. And then just a fifth wave up. But the fifth wave, if the top is in here now, the fifth wave up can't be longer than the third wave was, if this is the third wave up. Why would I even suggest that maybe the wave 3 top was occurring here now? So as we move into the daily chart, there you can see the potential of a 1, 2, and a short wave 3 and a wave 4. And the reason I would suggest that is because there's an 18-month cycle trough due in late July, early August in virtually everything. Been talking about this a long time. And I wanted to show you this week when I get into the expectation of some downward movement here. I wanted to show you something that I've added to the daily charts on the Dow Jones Industrial Average, the S&P, the NASDAQ, and the Russell this week, and I probably will keep it on there for a while. And it's all depends on how one phases this movement up. And the big question is was this the 40-week cycle trough? Now, the Dow Jones Industrial Average, it with no repins, is labeling that as a 40-week cycle trough. That was the low in around Halloween of last year. October 31, November 1 timeframe last year. And but the thing I was going to show you this week that and I wanted to make you aware of it. I've been aware of it for a couple of weeks, and I wanted to see if it would change. But I wanted to show you on Sentient Trader two different analyses. Well, one is a no repins analysis. And it'll take it a second to do it. But the really interesting thing that it is suggesting, at least on the S&P, is the 40-week cycle trough here did not occur on Halloween or November 1 of last year, that it actually occurred around March 4 of this year. And if you'll notice this analysis, the composite line is rather bearish from, the actual top tick of the composite line is late June, around June 28, then a plunge not down into July, August timeframe, but down into November of this year. And then a recovery that it suggests it may not necessarily make any more new highs. So this no repins analysis of the S&P 500 starting in January of 1950 is suggesting we're really close to major top in the markets. But I haven't been using this analysis, and there's several reasons why. One is the Dow Jones is putting the 40-week back here on Halloween of last year. So is the NASDAQ, and that's one reason. There's other highly correlated indices where it's placing the 40-week back here. The other is in this 18-month cycle, the yellow arch, within that 18-month cycle, there's supposed to be two 40-week cycles. There's this lime green one and this one. And so if the 40-week cycle ended here, then the next 40-week cycle would move down, and this would actually be the November time frame of this year would be the expected end of the 18-month cycle trough. Why am I choosing to not use this default analysis? And the reason is because in a bullish market, usually within an 18-month cycle, the 40-week cycle occurs early. It's what we call left translated. And it occurs a little before the peak, the midpoint of the 18-month cycle trough. And that is why I have continued to pin using one repin. And I'm going to switch back to that one. It just makes more sense to have a left translated 40-week cycle trough within the 18-month cycle, because the markets have been bullish, and when the market is bullish, you usually get these left translated. So here's a look at the S&P with that one repin back to October, late October of last year, 40 week. And then it puts a nice 20-week cycle trough here. And it puts an 80-day cycle trough right here. And so really, we're only looking for one more 80-day cycle down into a nest that would be basically an 18-month cycle nest that also included a 40-week, the 20-week, the 80-day, and so on. And that nest really resides around mid-July of this year. So that means we're only a month away, 1 month away from what I think is going to be the next 18-month cycle trough. And so that brings in several questions. And one is, if we're done with an ABC for wave one of an ending contracting diagonal, typically wave two of a diagonal is a deep pullback, at least a 0.618, and typically 66 to 81%. So since we only really have about a month left before that trough is due, that would be a really substantial plunge. That would be a very substantial plunge. Yeah, and the comment came in, can you turn on the composite line? Yeah, and there's the composite line that includes everything, including the sigma L. Now, if we don't include the sigma L, you can see it's been expecting a peak, and it's been expecting this move down through about August 3. And I believe turning the sigma L off is sometimes a really good idea, but from about right here, which is basically right today, it's bearish. If we turn the sigma L on, it really doesn't change it much, other than it suggests maybe a little more shallow of a pullback. But it still expects a pullback down through, and this date down here is August 3. So it's still expecting a pullback down into this 18-month cycle trough, and that's with the one repin. And when I do that one repin on the S&P, it pretty well matches up with the NASDAQ default no repins analysis. The analysis on the Dow Jones Industrial Average has become convoluted, because when I attempt to pin the 20-week here and the 80-day here, it won't let me do it. And this is why I've devised something for you this week, where I'm going to assume that, yes, this was the 40-week cycle trough in in the major indices. That would be the October 30 of last year, because it just makes sense. We get a slightly early 40 left translated 40-week cycle trough that would lead to more bullishness, which is exactly what we have had. So that's a strong clue that that's probably the 40-week. And so what I've done is the black. This is something called a cycle finder that is a indicator or a drawing tool inside of Trade Navigator. It's always been there. And it started at this low on March 23rd of 2020. And I used the cycle finder and I placed the first black or 40-week cycle here. And then you move ahead. And if you assume, and this is the assumption that always happens in cycle work, that the next 40-week cycle is going to be of identical length, then it would be occurring about now on approximately June 15. However, within that 40-week cycle, so there's two 40-week cycles in each 18-month cycle. So within this second 40-week cycle, in red, I've started here and placed the next 20-week cycle marker here, which I believe is the correct placement for that 20-week, because that's just about right in between. And this 80-day cycle here, most of the indices is considering the low that occurred in mid-May, an 80-day cycle trough. So moving, using the red line here to measure the distance of this 20-week cycle, then we move forward from there and expects the next 20-week cycle trough, if it's identical to the last one, to bottom around July 2nd. But within that 20-week cycle, there's two 80-day cycles. And if this is the 80-day cycle here, I've used a green cycle tool down here, and I've started here and figured that that is the distance of one 80-day cycle. So if we have the same distance to the next 80-day cycle, that, and I believe this is the most important date that I can develop using this manual system, the date for the next 80-day cycle trough, which should correspond with the next 20-week cycle trough, 40-week cycle trough, and 18-month cycle trough, is due August 3. And so I think we're going to see downward movement through August 3rd. And within an 80-day cycle, you have a 40-week, an 80-day cycle, you have a 40-day cycle trough in the middle of the 80-day cycle, and then you have another 40-day. And I sincerely doubt that the 40-day cycle trough has occurred yet. There hasn't been enough downward movement to put a marker in for a 40-day cycle trough. And when you look at what the cycles are saying, and I'm going to put on the semicircles. So we have an 18-month cycle trough that is starting to aggressively suggest that we're going to aggressively get some acceleration to the downside. We're right here. So the 40-week is also pointing aggressively down. So is the 20-week. And we're topping in the middle of the 80-day, that's the blue one now. So the upward movement we've seen since May 12, I think, is the first half of an 80-day cycle, and it's just about done. Then we're going to get the last half. So amazingly enough, this has been such a bullish cycle that we've really gotten down to just the downward movement down into the 18-month cycle trough is really only going to occur in the last half of the last 80-day cycle. And this is, I think, what's been going on in the markets for years, frankly. And I've talked about this, how the market will stay up, stay up, stay up, and then puke down into these large cycle troughs. The market went from an all-time high in February of 2020 to finish a 38% plunge down into March of just the next month. It only took 5 weeks for that 38% plunge to finish a large degree cycle. And now here we are. I would say we're about 6 weeks away from my best projected date for a bottom. And so I think it's time for this thing to get started to the downside. And that's all based on Hurst. It's all based on Hurst. So the question is, is that enough time to get a really big plunge? And I would say that it probably is enough time, but it's probably going to need some kind of catalyst from the entity that seems to be micromanaging the market today, and that is the Fed. And the market has been trained like Pavlov's dog to sniff the Fed's rear end and follow them wherever they go and whatever they do. And so they've been saying that they were going to hold the line on and continue to print mega amounts of money every month and to keep interest rates zero and all of that. But this week, this coming week, we have on Wednesday, I think it is, 2 p.m. Wednesday, Federal Reserve announcement, 2:30, Jerome Powell has his press conference. So this could be a critical event. And based on the cycles and the bearishness that I'm expecting in the second half of this 80-day cycle trough to finish all the way to an 18-month cycle trough, I think we're going to see a change of language from the Fed that the market isn't going to take very well. And they may not use the word transitory anymore. It's something along those lines. It's frankly, in my opinion, been criminal for the Fed to completely ignore their stated mandate of controlling inflation when we've seen inflation actually explode out of this March 2020 low, and now the most recent reading over 5%, and they're still doing nothing about it. And I just think that with a 5% plus reading there, I think they have to change the language here, and I think it's going to spook the market, and that's and then we're going to get this move to the downside. So in the case of the Dow Jones Industrial Average, using my manual phasing system, I'm expecting downward movement from about now down through August 3. That's what my count is calling for. And that the top on May 10, I'm calling that the end of an A, B, C for wave 1, and now we get an A, B, C down into early August for wave 2 of an ending contracting diagonal. But I have brought in an additional count on the Dow that I've been showing on the S&P, and that is that maybe this is wave 1 and 2, and we got a short wave 3, and now we're going to get a wave 4, in which case this pink line right here at 29,199 would become blue 4 double question mark invalidation. And I'm going to make that small since that's kind of my second alternate. And then we get a 3 and then a 4. The thing about that is that would bring in the top in the markets probably by the end of the year, or maybe the first quarter of next year, and the markets wouldn't be, because with the wave 3 shorter than wave 1 was, then wave 5 would have to be shorter than wave 3 was. So, but because the market has just absolutely positively refused to budge to the downside for a year and a half, almost a year and a half, I've had to come up with this alternate of just a wave 4. But frankly, it's bad news for the market. I think it tops a lot sooner. It would top a lot sooner, and probably in early 2022 instead of in 2023, if that's the case. So that's the Dow Jones Industrial Average. Here's a closer look at the main count. And I'm going to put this as a here and get this over in first days of August, something like that, a wave 4. And that is, we got a 1 and then an A, B, C for 2. That high right there is actually still holding, and now we're just starting to lean over just a little bit. And I can see some signs in the market that the market is a little worried, I think, about what is going to come out of the Fed this coming week on Wednesday. And you can see it in the bonds, what's happening with bonds, they're rallying. And you can see it in the financials. Financials have backed off, showed that they have backed off quite a bit. Last week was a pretty bearish week for financials. And so as we move through the webinar, we'll be talking more about all those things. Moving to the S&P, same identical scenario. The only difference in the S&P is on the very short-term count. And in the S&P, we had a new all-time high last week on Thursday, I believe it was. And whereas we did not get an all-time high in the Dow Jones Industrial Average, the all-time high in the Dow Jones Industrial Average is still standing from May 11. It's also interesting to note in my main count that looking for wave C, looking for this to be an A, B, C for wave 1 of a diagonal. The Dow moved on that date, on the date of the all-time high on May 10, exactly to that target, 34,968. It overshot it by just almost nothing. And then ever since, it hasn't been able to recapture that price. So a strong Fibonacci was reached, and that would suggest that yes, we got an A, B, C. It's not a 1, 2, 3. This would not at all be a typical target for a third wave. So, but in the S&P,